Thanks for joining us on Income Stacker, where we talk about building passive income. Today we're going to talk about the difference between FannieMae, FreddieMac, and FHA, and why is that important. So the reason I'm presenting this is I've gotten a lot of questions. People get very confused on the differences and what the role of each one is in the mortgage note business. So I thought I'd go over today in a brief 5-minute video to kind of clarify a few things. So let's get started. So FannieMae and FreddieMac. FannieMae, quick overview, was a result of the 1938 Depression to encourage home ownership. And FreddieMac, on the other hand, was a result of government trying to increase the liquidity and provide a secondary market for loans. What does that mean? So basically, the banks were lending money, but they would run out of money. So in order to put money back in the coffers, they came up with this FreddieMac government entity that would buy the loans, and then the bank would have their cash back so they can re-lend. Fannie and Freddie do not originate loans. Again, Fannie and Freddie do not originate loans. So a lot of people think that they do. They do not. They basically buy loans from banks, credit unions, and so on, which conform to their guidelines. So they have guidelines, and if a bank writes a note that conforms to their guidelines, then they will buy that particular note, and again, the bank will get money and liquidity from that transaction. So in addition, they really, as I said before, they provide liquidity by buying mortgages from the banks and investors. And then what they do is they take them, as we all heard about in the past, they bundle these things, they put them together in what's called a mortgage-backed security, and I'll explain that in a second, and sell to investors on Wall Street. So again, I'm not going to get into the super complexities of it, but it's pretty simple. They buy the loans, they put them together, and then they sell the loans back off, so they get their money back. So without Fannie and Freddie, now this is important now, without Fannie and Freddie, the rates for buying a home would be much higher, since there's not enough private sector demand for mortgages. So if we didn't have this system, pretty much the interest rates would be much higher than they are now. Also, Fannie and Freddie also buy FHA loans, which I'll talk about FHA loans in a second, and not just the conforming loans. Conforming loans are usually under the Fannie and Freddie umbrella. FHA loans are a little different. Again, they have their own underwriting standards, and they insure their loans. So a lot of times you'll see this word FannieMae, and that's really the name given to the security that's backed by the FHA loans. So let's take a look at what this looks like. So here on the left, we see a bank, right? Now the bank, what do? They originate a mortgage loan, and they give a homeowner a loan. And then what happens is FannieMae or FreddieMac, they purchase those loans, right? And then the bank gets their money back. So it's a big circular loop. Now, what does FannieMae do with all these loans? They take those loans and pool them together, and that's what's called a mortgage-backed security. And then they sell that pool of notes to investors, which in turn, again, fund FannieMae back. So again, the loop continues. So this is it. It's pretty simple. I think people get confused, but it's pretty straightforward and pretty simple. Again, this is, a little bit simplified version, but that's what most people want. Finally, FHA. What is FHA and what does it do? So FHA is an office of HUD, which insures mortgages for single-family residences, right? So they do not originate loans, and they do not buy loans. So unlike Fannie and Freddie, they do not buy loans. They simply, insure the loans, and Fannie and Freddie buys quite a bit of their paper as well. So FH loans are written by the bank using their guidelines set forth by FHA, which typically are a little bit looser and more flexible than a conforming loan, right? So usually the loans are meant to help a little bit less well-off people or people that want to be homeowners. However, there's no income limits, and you don't have to be a first-time home buyer. I think a lot of people think that an FH loan is for a first-time home buyer. It doesn't necessarily have to be. Also, there aren't income limits either on the low or the high side. So you can make $1 million or you can make $10,000 a year. You could still qualify for FHA loan. However, why most people avoid these type of loans that have good income is because the mortgage insurance. Now the good thing is the down payment's lower, right? 3.5%. However, there's mortgage insurance, and now I think since 2013, I believe they or 2014, I'm not sure which. In those one of those 2 years, FHA requires mortgage insurance to be on there, not just from the get-go, but for the entire life of the loan. Big game changer there. So for most loans, that's the case now. So that's kind of something that you really don't want to do unless you have to do in the case of a person that doesn't have, has less than perfect credit, for example. So hopefully that gives you a good overview of the difference between Fannie, Freddie, FHA, and that type of thing. So, you kind of understand it when you see the terms when you're reading articles and so on. So hopefully that helps. If you have any questions, of course, you can always shoot me an email. Make sure you sign up at incomestacker.com. If this is the first time watching one of these videos, sign up at Income Stacker for more free videos like this. And make sure you subscribe to our YouTube channel shown here. Thanks, and we'll see you on the next video.